But let me just take a minute to explain the presentation itself. Because what should you buy? The least expensive insurance that gives you the most coverage. Pure coverage. We're not talking about, different features that will do this and do that, like build a cash value for you, like a lot of companies sell. You never want to combine your investment in the same instrument as you do your pure insurance, okay? Because you'll never know what the actual cost of the insurance really is, okay? So less expensive term insurance is what you want to buy. Whole life cash savings plans to that, would you? You would not, insure your home and have an agent tack on a savings plan. No, you wouldn't do that. But people do that with life insurance. Might need child care if the man has to go out and do the work, or vice versa. The Mr. Mom situation, she's there working and he's at home raising the kids. That may be a very important addition to have as an insurance policy, that stay-at-home spouse. Experts, the Wall Street Journal, here's what they say about the different types of insurance. In short, term life remains the best choice for most people. It's the lowest cost, some significant coverage. All right? CNN Money, New York Daily News, we know about that, don't we, on that? Going with a more cost-effective term policy will likely serve most people better over time. The money you can save by going term instead of whole life can be saved and invested, okay? Those are important concepts to understand about the type of insurance that you protect your family. Policies is a couple of percentage points. Now, what does that mean in reality? If inflation, which historically runs 3 to 4%, if you're getting a 2% return on monies that are invested, you're getting screwed. Because when the time comes that you use and need to use that money, inflation will have taken place maybe over 30 years. You're going to see a slide about compound interest as it relates to on the wrong side of the equation. But you're not going to have a 3% hit. You're going to have a compounding of that 3% over 20 years. Gas in 20 years, I didn't think of what it's going to cost. But if you're saving today and getting 1%, or in a policy getting 1 or 2%, you're in deep trouble. Your spending power of those dollars in the future will be undermined by inflation. Okay? It's an important concept to remember. You made the minimum payments. This assumes an 18% APR annual percentage rate, minimum payment of 3.5% of the balance, or 20 or so or more dollars. Okay? So, what happens here, you're going to see something interesting. It's going to take 10 years to pay, and it's madness. Think of this. You go out to dinner every weekend. You use your card, your Master or your Visa, and you don't pay the balance. You keep doing it every month, and every month, at the end of the year, you got a couple grand and some nice dinners. And you keep making the minimum payments over time. And in 10 years, you've eaten the food 10 years ago. All right? And you're going to have spending financing that meal that you had, or those meals that you had 10 or fewer years earlier. Monthly debt payments. Only one of them twice. 2 of them make sense, the car and the mortgage. The others are madness. Okay? Debt stacking is a way to get out of this. All it says here, and you'll see it better on another slide, but let's say you went to a credit counselor and they worked out a plan for you. This is generally how they do it. They stack your debt. And if this is the monthly total that you have on the debt, you cut up everything except for, your mortgage and your car note, all of this stuff, kill it. And you pay off that first debt. So a loss of a job, a temporary health disability, you don't have health disability insurance, it's a loss of an income, so you would have enough to cover those expenses. Short-term purchases, car, maybe a down payment, or you have a team in the housing, teachers and people in nonprofit environments have access to, or any other tax deferred accounts. So you want to have 3 accounts so you can manage on a cash basis. Some people use as their emergency account their Master or their Visa card. And what's that going to do? Debt. Okay. Discipline? Okay. Doing it all the time? Dollar cost averaging? That's linked with discipline because you're going to keep buying every single month. You're going to use that same amount of savings and keep buying. Okay? And diversification. Not all your eggs are going to be in the same basket. You're not going to have all healthcare stocks. You're not going to have all oil stocks or all entertainment. You have a nice blend. And that's what mutual funds do. You said, one of the slides said that many funds have programs, spin it in,
instead of picking up a gun, increase your knowledge and that'll increase your funds. If everyone succeeds, then crime would decrease and people would live instead of resting in peace. Unity, that's what we need. Stand up and be a positive force in the community.